Let's start with a story. In this story, the lights don't flicker anymore when the system simply strains. They dim. In this story, it's 2028, the ATMs still work outside, thank goodness, the stock markets are still open, even more thank goodness, and the news anchors still smile and tell you that everything is okay. But something in this story, in this paradigm, it changed years earlier. Retirements are now frozen in temporary liquidity vehicles. Banks don't fail anymore. They merge overnight into huge conglomerates. Currencies don't collapse, they realign. And markets don't crash anymore, but they do definitely gap. Nobody remembers the exact moment when it broke because it didn't actually explode. It didn't go out of a bang, it went out of a whimper. It just adjusted. Rates were nudged, directions were changed subtly, liquidity facilities were extended, and balance sheets were stabilized. Volatility was suppressed and volatility was constrained. And by the time the people realized that the rules had actually changed, the game had already moved on. That's the dangerous part in the story. The monetary system doesn't die loudly, it just mutates quietly, and it's always the same every single time, in every imperial cycle, from the Dutch guilders to the French, to the Chinese, to the Americans, to the British. And by the end of this video, you'll see exactly where that pressure begins to leak. So let's jump right into it. What is the threat? Well, the threat is clear, the threat is unsullied, and the threat is more dangerous than ever. Because they've quietly broken the monetary system. The monetary system that we all know, the monetary system that we all rely on, they've absolutely broken it into something that we no longer actually truly recognize. And not with a crash, not with hyperinflation, not with a sovereign default. They broke it with intervention after intervention, layered with leverage upon leverage, layered upon dependency. Because the arithmetic is actually frighteningly simple and frighteningly clear. In the 2007s, global central bank balance sheets were roughly $6 trillion. And if you think about it, that's a huge amount of money. $6 trillion is huger than the GDP of most countries. But by 2021, it was even worse. It's exceeded $31 trillion. That's not stimulus anymore at that point. That is just structural engineering on a massive level. If you were a body, it would be genetic engineering to change you from, I don't know, a man to a woman or something else akin to that. The Federal Reserve expanded from 900 billion in 2007 to nearly 9 trillion in 2022. And the Bank of Japan now owns over 50%, yes, 50% of its government bond market. Global debt has risen from a massive 87 trillion, which is huge, in the 2000s to over 307 trillion today. Debt to global GDP now exceeds over 350%. So ask yourself this, can a system with $307 trillion in debt tolerate normalized rates? Rates going up? Probably not. Or must rates remain low and be politically contained? That is the real threat in this market. The mechanism is not inflation. It never really is. The mechanism is collateral fragility under rate normalization, to the point where rates cannot be normalized anymore. And most people are confused because markets still function. They still print new highs, they still print all-time highs, and they're still paying dividends into your 401k or your pension equivalent in whatever country you are. Indices are still printing all-time highs. Bond auctions are still clearing. None of them are failing. And currencies still trade. But that's just an illusion. And it's an illusion because the stress is underneath. And by the end of this, you'll see exactly where that pressure all leads and where the stress comes out. The irrepressible stress bursts out into the reality that is our pensions, our mortgages, our student loans. Because the debt saturation is always going to lead to a rate shock, which is going to lead to the collateral instability, which is going to lead to the liquidity intervention. It's the same cycle. That is always the cycle, and it will always be the cycle. Between March 2022 and July 2023, the Federal Reserve raised rates 125 basis points. That's the fastest tightening since Volcker. Now, Volcker was another central banker, if you're not familiar with him. He was the one who was meant to crush inflation, and he did so by raising rates. The US 10-year yield rose from 1.5% to 4.5% in our latest hiking cycle, not in the Volcker era. The Bloomberg US Aggregate Bond Index experienced its worst drawdown in modern history, down over 15% in 2022. Buy your pension. Now, that's not normal bond volatility. The MOVE index, which is a measure of bond volatility, that surged above 160. That's levels not seen since 2008, when there was actually a real crisis. Now, why does that matter? Because it's not all doom and gloom, and I'm not an apocalyptic type of guy. Because it matters because treasuries are not just safe assets. They are the global standard, they are the global benchmark, they are the repo collateral, they are the margin backing, they are the derivatives anchor, they are the foundation to your house. The US Treasury market is roughly $26 trillion in size. The repo market processes, get this, $4 trillion daily. So when yields actually spike, the collateral values drop off the cliff precipitously. And then when the collateral drops, the margin calls have to increase. And when the margin calls increase, the liquidity compresses. That's the cycle, and that's what leads to the pressure actually leaking. It's all the same, and it happens in historical parallels. Historical parallel number one. People think 2008 was a housing crisis. It actually wasn't. It was a collateral crisis. It was a solvency crisis, all wrapped up in subprime mortgages. Now, subprime defaults were the spark. Yeah, admittedly, I agree. But the explosion happened in the funding markets. That's where the pressure always leaks, when people are willing to lend you money. Credit default swaps widened months before the Lehman collapse in some kind of prophetic, apocalyptic forecast. LIBOR spreads all blew out. Interbank trust evaporated. The system didn't break because the home price actually fell. It broke because the leveraged balance sheets lost collateral integrity. When Lehman failed, when Lehman Brothers actually failed, global dollar funding markets froze. The Fed had to open up the swap lines, and that's what signaled the massive crisis. Peak dollar swap lines exceeded 580 billion. That's a huge amount of money to backstop the system. Now, that's not a coincidence. It never is a coincidence. That's the emergency plumbing, and it always works in the same way, to put money through the system, to pump it through the system, and to hope that the patient's arteries don't experience arteriosclerosis and go to myocardial infarction or a heart attack. And it worked. Thank goodness. No one likes to go through a heart attack, surely. But each intervention teaches the market something. The system will be stabilized no matter what. You have that erroneous belief system that everything's going to be stabilized and everything's going to be bailed out. The moral hazard is obviously going to compound. The leverage is going to rebuild with alacrity. The fragility is going to deepen. And the next time there's a crisis, you're going to need more and more capital to put out the fire. So let's talk about another historical parallel. Historical parallel number two, September 2022, the UK, where the 30-year yields rose from 3.5% to over 5% in only days. Pension funds using liability-driven investment strategies faced massive collateral and margin calls because they had levered exposure to the duration. And when the yields rose, the prices obviously fell. And when the prices fall, the collateral calls always hit. And when the collateral calls hit, the forced selling has to accelerate just to meet the demand for the margin calls. And when the Bank of England intervened within the days, emergency bond purchases ensued. And emergency bond purchases always ensue because it's not there to stimulate growth. It's there to prevent the system from stalling. It's there to prevent the systemic margin collapse, systemic margin spiraling. That wasn't just inflation management. It normally never is. It's structural fragility being exposed and then the cracks being pasted over. The market wasn't necessarily moving per se. The market was just repricing to the reality that the system could not be trusted. It was being forced. The liquidity was being pushed out. The leverage was being ramped up, and investors were demanding more protection, more money, and more interest rates for taking the risk. Does that sound familiar at all? Well, it should do, because it's the characteristic of every single liquidity crisis in a broken monetary system. There is also something that most retail investors never ever consider, And it's not their own fault. I mean, it's quite opaque, obfuscated and esoteric. The US dollar is the world's reserve currency. We all know that, and it comes along with an exorbitant privilege. We also all know that global trade is dominated in dollars, even though 25% of global trade is from America, but over 75% of it is denominated and settled in dollars. We all know that. So when dollar funding tightens, global stress increases. And in March 2022, the Federal Reserve expanded swap lines with major banks: ECB, Bank of Japan, Bank of England, Swiss National Bank, Bank of Canada. At the peak, over $480 billion were active in actual swap lines. Now, why? Well, you have to understand what a swap line is. A swap line is an agreement between two central banks to be able to exchange each other's currency in times of stress. Because global banks always need dollar liquidity. And when the dollar strengthens aggressively, emerging markets feel it first. When emerging markets start to feel it, most of their debt is denominated in dollar assets, which means dollar funding becomes tightened, capital has to migrate, funding tightens, liquidity compresses. And that cycle is not a virtuous one. That cycle is a killer of markets. Now, the system doesn't collapse in that scenario, but it does tighten, because it gets backstop, so it gets saved inherently. So in that situation, funding cycle from the dollars can quietly lead to the evaporation of liquidity in markets again and again and again. No matter how many times a central bank bails you out, or how many new acronyms they invent to bail out institutions, you have to come to the realization that we're at a reckoning point now. Volatility is now structural. The VIX long-term average is around 19. In 2022, it averaged above 25. So that means either we live in a risk-free world now, or volatility has just been suppressed. So bond volatility reached levels comparable to 2008, where there was an actual global financial crisis. Cross-currency basis swaps widened sharply. That is what we call funding stress. And when you have that funding stress, there's a rise of volatility products. Volatility products like zero DTE options, that's changed the intraday dynamics completely. Zero DTE options now account for roughly 45 to 50% of the S&P options volume. That's actually wild. That means dealer hedging flows can dominate price action intraday. That means they're completely delta hedging, they're hedging for gamma exposure, they're looking out for short squeezes, they're looking out for gamma squeezes, and the actual price action is driven by dealer hedging and dealer behavior rather than investment allocation. When volatility spikes, hedging amplifies the momentum, which amplifies the price. This is why you see 3% intraday swings with no major headline in huge markets that are worth trillions of dollars, because the plumbing is thinner, the system is more reflexive, convexity is way more powerful, and when the pressure builds, it leaks through volatility first, and it shows up in asset prices next. This is what leads us to the asset rotation, because who knows first? The capital knows first, the bond markets know first, the options markets know first. Since 2022, US market funds have ballooned about $6 trillion. Central banks purchased over 1,000 tons in gold in 2022 alone. That's the highest on record, and there's no sign of it abating. Gold repeatedly tested and broke above all-time highs despite rising yields. Why? Because capital seeks neutral collateral during systemic crises, not to mention the fact that central banks are seizing assets of other central banks, not to mention the fact that fiscal policy has not become any less incontinent. Japan has experienced periodic capital repatriation during yen volatility. Emerging markets have experienced outflows during dollar responses. That's not random. That's an actual migration of capital. That's a regime shift. That's a change in who we trust. That's a change in the dynamics of how we believe and where we should park our capital. When trust weakens, duration shortens. People's sensitivity to regime shifts become more and more pernicious. When duration actually shortens, liquidity preference increases. That's not a rally, it's just positioning. It's what people are saying: I don't feel safe in this anymore, I need to get out. I don't know if I can trust this government to meet their liabilities anymore, I need to get out. And then it's all of a flood all of a sudden in some diluvian fashion. And the debt math becomes inescapable at that point. You can no longer start to discount the fact that, hey, we can fund these deficits at 5 or 6%, because you can't do that anymore. The debt math becomes intractable and inexorable. What does an inescapable debt math problem look like? Well, it looks like $36 trillion of debt. 1% average interest rate, 350 billion a year. 5% interest rate, 1.7 trillion annual a year. Interest expense is now exceeding $1 trillion per year. Interest alone, that's more than defense, more than healthcare, more than education, more than any discretionary program. Japan's debt has exceeded 250% of GDP a long time ago. The Bank of Japan now owns half of all the JGBs, and that's probably where America is heading soon, if it's not for a stable coin to come and save it. If yields are allowed to rise freely, fiscal strength and stress always intensifies. So the yields must be managed. That's why we have yield curve control. That's why we have quantitative easing. That's why we have banks buying the debt of governments, the monetization of the debt, primary dealers being in tacit agreements with governments to fund the debt no matter what. Managed yields have a problem though. They always distort the price discovery. In a system that's completely managed and the liquidity is fabricated, price discovery is always distorted. The system becomes policy dependent and the system requires you to bail it out all of the time. And policy dependent systems do not clear stress naturally. They just suppress it until it leaks uncontrollably all over the floor, until your pension is completely withered away, until your student loan is the thing that's collapsing the economy, until you can no longer get a credit card that's under 30% APR. And that leads us to the inevitable loop, the inevitable death loop, the cataclysmic loop. And it always follows this same regime in every single empire that reaches this financialization and this level of fiscal stress. Something tightens in the system, that leads to stress, that leads to the governments of the day injecting stimulus and liquidity, and then they rinse and repeat that over and over again. And every cycle increases that fragility and it amplifies it ever more, layered upon layer. Every injection conditions the market. Every rescue encourages the leverage. Every bailout encourages moral hazard. That's not a conspiracy. Conspiracies are all being proven true these days, especially in the financial markets. It's not conspiracy, it's an incentive structure, because they realise what's going to happen because it's happened before. If markets believe the intervention is guaranteed, then the risk is going to expand. If the risk expands, then the fragility is going to deepen. If the fragility deepens, the volatility is going to become structural. If the volatility becomes structural, that's where the pressure is going to leak. And it's going to be a rinse and repeat, rinse and repeat. And unless you're positioned for it, you're going to be losing in that system. TLDR, long story short, what does that mean for you? What does that mean for me? What does that mean for traders? It means stop trading headlines. Stop trading where you think the puck is and where it's going to be. Don't trade the market you have. Don't trade the market you want it to be. Trade the market where you think the liquidity is going to be going to. Upside is policy driven. Downside is liquidity driven. Liquidity moves faster than policy can. It's like the huge turning circle of a massive ship. It's going to take time and you're probably going to get bankrupted or drowned before it does really happen, because the convexity matters. The rate of change, the deltas matter. You want asymmetry when gamma positioning is fragile. You want optionality when volatility is suppressed. And you want that exposure that benefits from the disorder, because when collateral cracks, price doesn't drift, it just gaps up, it explodes, it leaves the deviations, it has sigma events, and gaps are always convex. And convexity can either be on your side or against you. And if it's against you, you're going to be up shit creek without a paddle. The monetary system is indeed broken. They didn't collapse it, they just conditioned it. They layered debt, over intervention, over liquidity backstops. The system still functions. Yeah, the patient is still alive, but it's more reflexive, it's more sensitive, it's more policy dependent, and it's more forward looking in terms of where their next injection, liquidity, is going to be coming from. Volatility is not actually the noise anymore. The volatility is the signal to where you should be positioned. And you're not positioning for the headline, you're positioning for the reaction to the headline. The collateral is no longer static. It can be moving, it can be freeform, it can be changeable, and most dangerously, it can be political. And the next time that liquidity actually compresses, the next time the funding tightens, the next time the yields all spike, you won't be asking the simple question of, what happened? Why didn't I see this in the headlines? Why wasn't I warned about it? You won't be doing that. You'll be watching the plumbing. You'll be seeing what the policy intervention is going to be. You'll be forward trading what you think institutions and authorities are going to be looking out for next. You'll be looking at the funding markets, where the stress is going to be. You'll be watching the volatility service, and you'll be thinking something like this. Where's it going to leak next? Where's the liquidity going to show up, and how a government's going to bail this out? And in a system that was built like that, it's never going to go out with a bang. It's always going to die quietly, because convexity isn't the speculation in this regime. It's just the preparation. And that's how you have to be thinking about these markets. Ciao for now.